Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Firefly Aerospace.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Right, and before we get to the charts today, just a quick note on tools. If you want help reading trading charts, a bit more clearly, you can check out VIP Algos through the link below in the description.
Yeah, highly recommend looking into that.
Exactly. VIP Algos is an educational chart analysis tool, basically a TradingView indicator suite. It gives you visual buy and sell chart alerts, trend direction tools, support and resistance zones, and areas to plan your take profits and stop losses.
Really handy for visualizing the setup.
It is. It works across different markets like stocks, forex, crypto, gold, futures. But please remember, VIP Algos is purely for educational chart analysis. It is not financial advice, it does not place trades for you, and it absolutely does not guarantee profits.
Right. Trading always involves risk.
Always. So you must manage your risk and do your own research. That link below in the description is an affiliate link, so we may earn a commission if you use it, at no extra cost to you.
Awesome. Okay, so let's unpack the market story unfolding right now. Because if you are watching the space sector at all, you already know things are just incredibly volatile.
Absolutely, up and down every day.
Right. But Firefly Aerospace, trading under the ticker FLY, they are kind of actively breaking the mold here. They recently surged roughly, I think it was 6.5%, on this massive wave of sector enthusiasm.
Yeah, really strong momentum.
And what makes this really fascinating is that they are actively decoupling from peers. Like you look at Rocket Lab and Planet Lab.
Right, those have been struggling.
Exactly. They've actually been falling ahead of the highly anticipated SpaceX initial public offering. So today, we are, going out to the launch pad to figure out if this sudden momentum is fundamentally justified. Like, does the underlying business actually support all this hype?
It's the perfect question to ask right now.
Yeah.
Because when you see a single stock breaking away from the gravitational pull of its entire peer group, you really have to dig into the mechanics.
Yeah, you have to wonder if it's real.
Exactly. Is it a temporary rotation, or is the market fundamentally, repricing the company because of what they're actually building?
Right. And before we get into the weeds of their balance sheet, I think we have to look at the actual, the philosophy of holding a space stock right now.
The broader context, yeah.
Because honestly, my immediate instinct when I see a commercial space company is just extreme caution.
I don't blame you.
I mean, we've seen this hype cycle so many times, right? A company promises revolutionary orbital logistics, retail investors pile in, and then
Timeline slip
by like 3 years. And shareholder value is completely wiped out. So looking at Firefly, how should you be viewing this? Is this just a quick speculative trade, or is there a genuine multi-year portfolio case here?
Well, you really should view it strictly as a long-term growth and infrastructure play. If you look at Firefly purely as a niche launch provider, just another company building disposable rockets to put satellites in low Earth orbit,
You're missing the point.
you're completely missing the larger thesis. They are actively transitioning away from just being a service provider. They're turning into a highly diversified space and defense platform.
Defense platform.
Yeah, they were building embedded, long-term infrastructure that directly connects United States defense networks with civil space initiatives.
Okay, but isn't the entire sector essentially built on future promises? I mean, for an investor planning a multi-year horizon, saying you're transitioning from consumer tech to defense infrastructure, it sounds really great in a press release.
Sure, it sounds amazing.
But it still feels like a massive high-risk gamble.
Oh, it is absolutely a high-risk, high-reward profile. But here is the critical difference. The reward side of the equation is grounded in massive defense contracts, not just consumer adoption.
Right, Uncle Sam's checkbook.
Exactly. When a company's technology gets embedded into defense architecture, yes, the investment timeline lengthens, but the contracts become incredibly sticky.
They don't just switch providers overnight.
Right. The military doesn't change software providers or orbital logistics partners on a whim. Once you are integrated, it creates these multi-year recurring revenue streams. So the context here is positioning yourself to capture the value of an infrastructure build-out before that infrastructure is fully mature.
Okay, so if the goal is embedding themselves into national defense architecture, how is that actually showing up in the bank account today? Because looking at the first quarter of 2026, the numbers paint a very, let's say, intense picture.
They do. It's high stakes. Let's break down the revenue trajectory first.
Go for it.
So first quarter 2026 revenue came in at $80.9 million.
Right.
That is a 40% increase year over year, which is solid. But the market is looking forward, right? And management's guidance for the full year of 2026 is a staggering $420 million to $450 million.
Wait, hold on. Let me just do the math on that. If their 2025 revenue was roughly $159.9 million, hitting the midpoint of that new guidance implies growth of around, what, 181%?
Yeah, roughly 180%.
That isn't just growth. That is hyper growth.
Yeah.
How are they mechanically achieving that when their peers are struggling just to, scale up a basic launch cadence?
It comes down to their competitive moat, which is aggressive vertical integration. A lot of their peers, they just pick a single lane.
Like just building rockets.
Exactly. They only manufacture launch vehicles, or they only write tracking software. Firefly does it all. They have the Alpha and Eclipse medium launch vehicles. They have the Blue Ghost leaner landers.
Right, the moon stuff.
Yeah, and they have Elytra, which is an in-space transportation system. And crucially, they have SciTech.
SciTech.
Right? SciTech is their high-margin, AI-driven defense software subsidiary.
I want to expand on that vertical integration point because I kind of think of it like the supply chain of a national delivery service. A lot of these space companies are just building the delivery trucks.
That's a great analogy.
But Firefly is like building the trucks, they're paving the orbital highways, they own the destination hubs on the moon, and they own the logistics software running the entire grid.
That is exactly how you have to visualize it. And because they own the entire grid, they capture margins at every single step of a mission.
Which creates scarcity value.
Massive scarcity value for investors. Take the moon, for example. Firefly is currently the only publicly listed winner of NASA's recent South Pole contracts.
The only one.
The only publicly listed one. So if an institutional fund or, a retail investor wants direct public market exposure to the commercialization of the lunar South Pole, Firefly is practically the only door they can walk through right now.
Wow.
Furthermore, look at their Elytra vehicle, which hosts the Ocula Lunar Imaging Service. Ocula provides 20-centimeter resolution imaging from lunar orbit. Right now, there is zero commercial competition for that specific service.
Zero competition is a beautiful phrase for a business, but let me push back hard here.
Sure.
Owning the grid is fantastic in theory, but maintaining that grid before it's fully operational is bleeding them dry. The bottom line paints a much harsher reality.
It's expensive.
Very. In that same first quarter of 2026, they posted a net loss of $96.7 million. Their free cash flow was negative $78.9 million.
Right.
They are burning cash at a terrifying rate. If I am looking at this, a nearly $100 million quarterly loss is a massive flashing red warning light.
It would be a massive warning light if this were, say, a mature consumer goods company. Yeah. But in the heavy aerospace and defense sector, scaling manufacturing and building orbital machinery requires massive upfront capital.
So the burn is expected.
Exactly. The question the market is asking isn't whether they are burning cash. Everyone knows they are. The question is, do they have the runway to survive the burn?
And do they?
And the answer is yes. Firefly is sitting on a massive estimated gross cash balance of roughly $893 million.
$893 million. That is a serious war chest. Where did they even secure that kind of liquidity in this environment?
A significant portion came from a recent follow-on public offering, where they raised about $200 million at $48 per share.
Okay, got it.
And on top of that cash pile, they also have $300 million in undrawn borrowing capacity.
So they have a safety net.
Exactly. So yes, the burn rate is incredibly high, but that cash buffer gives them years of operational runway. They are aggressively deploying that capital into facility expansions down in Texas to build automated manufacturing machinery.
To get to profitability.
Right. Management has stated they expect to reach break-even profitability by late 2026. With nearly $1 billion in total liquidity, they can bridge that gap without constantly coming back to the market and diluting shareholders.
Well, a massive cash pile is great for survival, but, survival alone doesn't trigger a stock to break out. To justify this recent momentum, we need to see what's actually going to change the valuation.
The catalysts.
Exactly. Let's move to the catalyst timeline. What are the specific events that could structurally re-rate this company?
Well, the nearest-term hurdle is their second quarter 2026 earnings report. The market is going to be hyper-focused on one specific metric, and that's conversion.
Converting the guidance.
Right. Can Firefly prove that they are converting that $420 million guidance into actual signed binding backlog? And equally important, are they demonstrating that the cash burn is starting to curb as those revenues finally hit the books?
So Q2 is really about proving the math. But there is a massive macro catalyst looming over this entire sector, and that is the SpaceX initial public offering.
Oh, absolutely. The SpaceX debut is the undeniable gravity well of the entire market right now. Current estimates suggest SpaceX could achieve a valuation somewhere between $1.5 trillion and $1.75 trillion.
That's just astronomical.
It is.
Yeah.
And to put that in perspective, that implies roughly a 75 times forward price-to-sales multiple.
Okay, let's break down what that forward price-to-sales multiple actually means for anyone who, doesn't spend all day looking at valuation models. It means the market is essentially willing to pay $75 today for every $1 of sales SpaceX expects to make over the next year.
Exactly.
It shows extreme confidence in their future dominance.
Mm-hmm.
But what is Firefly currently trading at?
Firefly is trading at roughly a 10.3 times price-to-sales multiple.
Okay, here is where it gets incredibly interesting. If the undisputed king of the sector goes public and the market establishes that 75 times sales is the new premium benchmark for a successful space company.
The whole scale shifts.
Right. Suddenly paying 10 times sales for Firefly looks like an absolute fire sale. It creates this vacuum effect.
Exactly. It triggers what we call a sector-wide re-rating. When the benchmark shifts that dramatically upward, the rising valuation can lift the secondary companies that look fundamentally undervalued by comparison.
Makes total sense.
But beyond the SpaceX IPO, we also have major, tangible defense budget catalysts.
Right, and military side.
The Pentagon is pushing heavily into the Space-Based Interceptor Program, which is a $3.2 billion initiative. There's also the Golden Dome initiative. Both of these provide massive long-term structural tailwinds for Firefly's AI defense software subsidiary, SciTech.
Let's talk about SciTech for a second and why software matters so much here. Because launching rockets has notoriously thin margins. Hardware is extremely expensive to build and, frankly, easy to blow up.
Very easy to blow up.
But software scales infinitely at almost zero marginal cost. If SciTech's AI can provide predictive tracking and threat assessment for the military, that recurring revenue fundamentally changes Firefly's profitability timeline.
It changes the whole narrative.
Now, I also want to address the rumors floating around, because CEO Jason Kim recently mentioned ongoing discussions with NASA for a block buy of 5 to 10 lunar landers. Depending on the configuration, that single contract could be worth anywhere from $500 million to $1.4 billion.
It is a staggering potential number, but we have to be absolutely clear here. That is entirely unconfirmed.
Right. And as a participant in the market, you absolutely cannot count on unconfirmed government block buys before the ink is dry. Political budgets stall, administrations change priorities, timelines get delayed by years.
It happens all the time.
You just cannot bake an unconfirmed billion-dollar rumor into your baseline valuation.
You are absolutely right to be cautious. You have to treat the NASA block buy as a potential bonus, not a certainty. However, the macro effect of the SpaceX IPO and the scheduled activation of Firefly's Oculus Lunar Telescope in late 2026, those are imminent, tangible milestones.
Real events.
Right. Those are the catalysts that will force institutional capital to pay attention.
So catalysts tell us what could change the story, but price action tells us how the market is actually digesting that story today. Let's pivot to the technicals.
Sure. Looking at the chart, Firefly has certainly taken a beating since its early days. It is currently trading down roughly 37% from its post-IPO all-time high of around $60.
It is a significant drawdown, but the recent price action tells a much more optimistic story, I think. The stock has essentially built what technicians call a coiling base. It has found very strong proven support right around that $48 level.
Yep, the $48 mark.
And it is no coincidence that $48 was exactly the price of the recent massive public offering.
And this is a crucial point for understanding market mechanics. The company sold nearly 10 million shares into the open market at $48. Normally, a secondary offering of that massive size floods the market with new supply.
It tanks the price.
It usually crushes the stock price downward, yeah. The fact that the market absorbed all 10 million shares seamlessly and the stock did not collapse below $48 is a massive signal. It means intense institutional demand was waiting right there to buy everything they offered.
Okay, let's translate that for anyone who doesn't stare at order books all day. Because of that absorption, analysts are saying the float is now cleaner and the overhang is gone. What does that actually mean mechanically?
Well, the float is just the number of shares actively available for the public to trade. An overhang happens when investors know there is a huge block of shares waiting to be sold. It acts like an artificial ceiling on the price because buyers know a massive wave of supply is coming.
They don't want to buy before the dump.
Exactly. Because that offering is now complete. That wave of supply has already hit the shore. The overhang is gone. The institutional buyers holding those new shares aren't looking to flip them for a quick penny. They're holding for the long term, which cleans up the available float.
And from a charting perspective, without that overhang holding the price down, if they continue to scale their manufacturing, analysts are targeting a confident break past the major institutional resistance zone, sitting up at $55 and above.
That is the setup. You have strong support proven by institutional buying at 48, a cleaner float with less selling pressure, and a clear resistance target to clear above 55.
Now, I always have to play the skeptic when we talk about charts. Charts show us structures, they show us probabilities based on past human behavior, but they absolutely do not guarantee future outcomes.
Never.
A beautifully constructed support line at $48 will shatter instantly if the macro environment turns sour or, God forbid, if a rocket explodes on the pad.
That is precisely why context and risk management matters so much. A chart doesn't trade in a vacuum. Though I will say, having tools to clearly visualize where those key support and resistance zones are is exactly why a cleaner chart workflow can be so helpful when you are scanning these setups and planning your downside risk.
Right, absolutely. So price action gives us the battle lines, but what does the overall market sentiment look like? Because we mentioned earlier that Firefly was actively decoupling from its peers. Why are they acting so differently?
The institutional sentiment right now is distinctly bullish. And that is fascinating because the broader space sector is actually quite skittish ahead of the SpaceX IPO. You are seeing pure play, single-lane launch companies trading lower as investors pull their money out. But Firefly is moving up.
It suggests that the smart money, the institutional capital, is actively rotating.
Rotating their exposure, yeah.
They're pulling liquidity out of space stocks that look overvalued or heavily reliant on a single risky revenue stream like hardware launch, and they are funneling it into Firefly's discounted growth profile.
And that optimism is structurally justified by their diversification. Because Firefly has SciTech and that embedded defense software revenue, institutional investors perceive them as a safe haven compared to companies that only launch rockets.
Software is just safer.
Right. Software contracts with the Pentagon offer a level of stability and predictability that physical space launches just don't have yet.
That makes total sense. And the analysts covering the stock are really reflecting that sentiment. Roth Capital recently maintained a buy rating with a $60 price target, specifically citing their strong cash position and the sheer scale of the defense opportunity.
Yeah, that was a strong note.
And Seeking Alpha also has them as a buy with a $53 target, pointing to the high margin defense revenue and the fact that the stock looks fundamentally undervalued compared to peers.
Add to that the recent validation from the Space Force regarding Firefly's 24-hour responsive launch capability.
Oh, we definitely need to highlight how important that 24-hour capability is. Because in a modern geopolitical conflict, if a foreign adversary disables a United States communications or spy satellite, the military cannot afford to wait 6 months for a scheduled commercial launch to replace it.
They need to replace tomorrow.
Exactly. Being able to roll a rocket out, integrate a payload, and launch it into a specific orbit within 24 hours of receiving the order is a massive strategic advantage. That news alone has fundamentally shifted how the Pentagon views Firefly, adding tremendous momentum to the bullish narrative.
But, we can't just paint a rosy picture here. We still need to talk about the risks.
Always.
Because no matter how good the cash position or the defense contracts look, this is still heavy aerospace, and the physics of spaceflight are unforgiving.
Let's talk about the absolute highest threat to an investor's capital here, which is execution risk.
Yeah.
We mentioned earlier that they are spending more than $1 for every dollar they earn right now.
Burning cash.
Yes, they have an $893 million buffer. But if their operational timelines slip, which, let's be perfectly honest, is notoriously standard in the aerospace industry, that cash pile will evaporate much faster than anyone is projecting.
That is an incredibly valid point. Building space infrastructure is hard. If their path to profitability gets pushed from late 2026 into 2027 or 2028 because of manufacturing delays or launch failures, the market will severely punish the stock. The runway is long, but it is not infinite.
And we also have to look at the macro sector rotation threat. We talked about Firefly currently decoupling and acting as a safe haven, but there is a very real scenario where the SpaceX IPO is so massive that it acts like a financial black hole.
Just sucks the air out of the room.
Exactly. Because liquidity in the market is finite, it could suck all the available capital out of existing public space stocks, regardless of how good Firefly's fundamentals are, simply because every fund manager on Earth wants to own the new king of the sector.
That is the downside reality of market mechanics. Even if Firefly executes your business plan perfectly, macro capital reallocation could still drag the share price down in the short term. You just cannot hide from broader market liquidity moving to a perceived safer, larger asset.
So putting all the pieces together, the massive cash pile, the vertically integrated tech, the intense cash burn, and the execution risks, where do we land on the final verdict?
Well, looking comprehensively at the fundamentals, the technical setup, and the catalyst timeline, the analysis delivers a bullish score of 8 out of 10.
An 8 out of 10 is a highly confident rating.
It is. The stance here is that Firefly Aerospace is a highly undervalued space and defense platform offering an asymmetric risk-reward profile. The upside potential driven by their multiple revenue streams, especially the high-margin defense software and the lunar infrastructure, outweighs the execution risks.
Mostly because of the cash.
Exactly. It's largely due to that massive cash war chest, insulating them from the immediate threat of shareholder dilution.
But the timeline is critical for anyone considering this. This is not a short-term speculative flip. The long-term view is that this requires a multi-year hold, specifically a 12 to 24-month horizon. You are analyzing this now to capture the value of their path to that late 2026 break-even mark and waiting for the full maturation of these defense and NASA contracts.
It has to be patient.
It requires patience and a high tolerance for the volatility inherent to aerospace.
Absolutely. The main upside driver is that combination of scaling revenue and the potential sector-wide re-rating from the SpaceX IPO. And the main downside risk remains operational timeline slippage, eating into their cash reserves before they cross that profitability finish line.
And as always, we must clearly remind everyone that this analysis is not financial advice. We are breaking down the business models and the market mechanics, but you must do your own research and make your own decisions based on your personal risk profile and investment timeline. And if you are looking for a cleaner way to read your trading charts as you do that research, check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite designed as an educational chart analysis tool. It gives you visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas.
Very useful.
It can help make complex charts easier to scan, but remember, it is strictly an educational tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always manage your risk. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this discussion helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua.
Until next time, I want to leave you with one lingering thought to mull over. We talked a lot about Firefly being the only public company with access to the lunar South Pole, but as nations begin realizing the strategic defense value of that specific lunar real estate, the ice, the high ground, how quickly does a commercial logistics contract turn into a heavily classified geopolitical space race, and how does a company like Firefly navigate basically being the delivery truck for a new Cold War? Keep asking the hard questions, and we'll see you next time.